Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard.
It's hotter than crap outside.
And going to continue to be for a while. Our lake's down about 15 feet. I think we lose a foot every other day, it seems like.
Is it going to be you live on Lake Louisville or something, right?
Yeah.
Are you going to get your boat out in that?
I've got 9 feet behind me right now, so.
Oh, that's still pretty decent.
Yeah, it's, each foot of shoreline probably is only equivalent to, a couple of inches, because depending on the grade of the shoreline. But it's not good, and it's hot. I was talking to my mom, and, we moved her here from Illinois, 4 years ago or so. Time flies when you're having fun. And she told me today on the way to work, I was chatting with her, she goes, Guy, I'm praying for snow. I said, that's funny.
We're like 108 degrees or something this week. I mean, this week is crazy.
We've got friends in San Antonio and Austin, and we're a degree or two hotter than them right now.
I got
your family's in Austin.
I forgot to water my lawn, so I've been watering almost every day.
Right.
And they said, wait a minute, you're not watering outside restrictions. One of the neighbors,
go,
no. How come yours is greener? I don't know.
I know.
Don't be knocking me out.
I already warned my wife. I warned Chris. I said, water bill's going to be like an extra 100 or 2 this month, because I've got to, don't want to lose the lawn, because that's crazy money.
You have the pump permit for the lake yet?
No, I got to get a pump permit, an easement, and then those filters. I don't know how you stick that canister in there, because you know how boats get the algae on the bottom. I don't know how you'd stick that canister sucking out of the bottom of the lake without it getting clogged all the time.
It does get clogged all the time.
Right,
You got to go clean it.
Yeah, like several times a year.
Yeah.
Oh, great, more maintenance. That's wonderful.
I had a lake house for a lot of years, and there's a lot of maintenance.
My mom told me, just like your dad did. I remember when you bought your lake house 20 years ago or 15 years ago. She goes, I don't know if you know what you're getting into. It's a lot of work. Oh, no problem. This is what I want to do. It's a lot of work.
This 2-story dock, and they didn't tell me you got to replace the boards up there about every 2 years. I'm like, what?
It's crazy.
Get all warped. You get bugs everywhere, and you got to clean up the bugs.
Thank God you've got a good retirement plan and a good advisor
right.
to say thank you, Guy.
That's right. All right, let's get into it. Social Security. They could have a cost of living adjustment, or COLA, next year that'll top 3%.
Crazy.
That'll be the highest in many, many years. What they do is they base it on the CPI through April of 18.
Consumer Price Index,
right.
If you're not familiar with the acronym.
And so if you remember, there's only, I think,
which is manipulated.
4 or 5 years in history it didn't have an increase, but 3 of those years are like the last
recent.
6.
Yeah, very recent.
But last year it did go up.
Fraction.
I think it was, 0.3?
Yeah.
No. This year it could be over 3, which is good. But if they go too much, here's the only drawback to that kind of thing. If they raise Social Security too much at any given time, they're going to figure out which part of that CPI they don't like and take it out, just like they did energy a few years ago. Now, for anybody out there, I don't know how energy isn't a large part of your household expenses, right?
Absolutely.
They just took it out. So now if something else comes out, they'll take that out too.
I believe, and I'm doing this off the cuff, they've done it several times. I think they took beef out and substituted chicken, and they as it suits their needs statistically, they adjust it.
Right. What do you mean? We can't trust the government to give us money? Or?
It's it's a swampy thing there.
All right. So that's a good thing. So next year I think the average person can see a raise of $40-something. Remember the last time they did a raise, though? They raised your Medicare premiums to offset it.
The reason, which is you think they raised your Social Security so they could get it from the Medicare.
All right. Here's the question I get all the time. All the time I get this. I look at portfolios all day long. We've been doing this 30 years each. I'll see an 80-year-old with a bunch of life insurance policies. And now these people might have several $1 million. I'm always like, well, do I need life insurance? I go, do you have any handicapped children? No. Your kids are all grown, right? Yeah. You're going to leave them millions of dollars if you die, right? Yeah. Why do you need life insurance?
And if you die, your spouse will be okay, right?
Right. And what one of them told me was, this is the interesting one. It said it always used to pay off. It was more than the premium. Okay. But now it's turning. At a certain age, the premium will outstrip the dividends or whatever.
Cost
so
of
now
insurance.
It's costing me money. I go, you don't realize for that 30 years it cost you money the whole time. No, it was. it would have made that much more if you didn't pay insurance premiums out of it.
Exactly.
In other words, you could have made. You have to look at it compared to another investment.
But at a younger age, it's a slower rate.
That's why this, what is it? Buy on yourself. What is it? Invest in yourself. What's
bank
it?
on
bank on yourself.
Bank on yourself. I think
all those guys are just selling life insurance policies. There's only two things that's tax free in this world that you can get income, monthly income, or whatever, and it's municipal bonds and life insurance. So anytime you hear a tax free retirement, boy, just know it's a life insurance policy.
And to make a real good point here, again, whether it's life insurance, whether it's annuities, whether it's bonds, whether it's somebody to manage your money, all of those things can be good, but it's got to be the right peg for the right hole, right? If you have a square hole, you want a square peg. If you have a round hole, you want a round peg. Anybody that just does one thing, and most of these guys, I believe Bank on Yourself only does life insurance. Ken Fisher only does managed money, so God forbid you do anything else. Some people only do annuities, so you can only do that. There's bond people out there, friends of ours. That's all they do is bonds. Well, right now, bonds aren't really the thing to do.
Right.
It depends.
Well, think about it. If you come to someone that's unidirectional or whatever, they say, I've got an issue here, what can you do? Well, I think bonds are the only thing you can do. Or I think the solution to every problem you might have, retirement planning, financial planning, everything, estate planning is going to have to be stocks and bonds, like a managed program like this one.
And the spiel they'll give you will be true, but I don't think they always give the whole picture. You'll never lose a dime. Well, you won't if you hold them to term, right? If you hold it for 30 years, you're fine. But, I mean, who wants a 30-year investment?
Right. 30 years is a little strong.
Yeah.
The problem is when interest rates go up, bonds go down. So the longer the bond, the more risks they have. So therefore, the bond will go down a lot. You can lose, right now, long bonds, you could have a 20-30% hit on those things. The higher yielding the bond, the worse your hit can be. Because remember, higher yield means junk bonds. You're loaning money to companies with bad credit.
I've got clients right now, in fact, one that's just inherited a fairly large portion of money that's in tax-free bonds. They're paying 5%. Now, think about that. They paid a premium to get those back when they did. They didn't buy them recently, but they paid a premium to get those. But it's paying 5%. The only thing you can get is 3% now. Well, they paid a premium, right? So that's the amount of money that came out of the portfolio. And as rates come up, what happens if rates come up to 5% or up to 4%? Now it's at par, right? It's the premium. They've lost their premium, so they've still lost money on it. So is that the right asset to hold in your portfolio right now? Probably not.
I don't know how many portfolios I've looked at over the decades that they give me a line. I'm making 5%. You're not making 5% if you pay $1,200 on $1,000.
On $1,000, 20% premium.
That's right. There's no way. It's impossible. And if you're getting a bond right now, let's say you got a brand new bond paying 5%, it's crap. Municipal bonds aren't paying 5%. You're getting a crappy one. Or you'll get one that's subject to AMT.
I love the way you put that, but it's true.
No, you're getting one that's not good. It's just like Chicago right now. They were having 8% municipal bonds. They're like, wow, that's stupid not to do those. There's a reason why they're 8%. They got their economies in shambles. And did you see what they decided to do last week?
I did not.
They decided to do this flat income thing.
Oh, no, I did see it. I did see it.
Okay, they're flat broke, highest crime in the world, right?
Yep.
And now they decide we're just going to give people money. No, you don't have to do anything with it. You can purchase anything you want. Go purchase booze, marijuana, whatever the hell you want with it. They think it's a, what is it called? Like a standard income or national income.
They did it in Sweden or Switzerland or Deutsch, somewhere over there, not Deutsch,
Germany?
The Dutch, no. But somewhere over there they've tried this and it failed miserably, like Venezuela's socialism, South America's socialism, and the whole 9 yards.
Socialism does not work, period.
I love Margaret. Boy, I had my tooth operated on Tuesday. Let's go with that surgery. Anyway, Margaret Thatcher said, socialism is great until you run out of the other person's money. Right. I just love it. It's so accurate.
Well, I tried to explain to my son. I go, think about if you're creating a society. You're creating a society, and then some people are working their butt off. They're building everything. They built 3 houses. The other one's sitting there. They don't need to work. They're going to get the same pay. So after a few months of this, what do you think the people that are working 12 hours a day are looking at the person not working at all? They're a pariah. Get them out of here, blah, blah, blah. It doesn't work.
Or you lose your motivation. You don't work as hard.
Or then everybody quits working.
That's right.
Well, let's not do anything because we get the same thing anyway. Communism is like that, except it's forced. They kill you if you don't like it.
The one great thing about capitalism, not to get too political, is the idea is you're supposed to get what you deserve. You work harder, you get more if you want more. I mean, some people are happy with 100,000 a year, some 2, some 500, and that's okay. But everyone they seek their own level.
Right. Hey, they did a little thing on 401ks. They expanded the loan provision stuff here with this last tax thing with the tax bill. Used to be you could take out the part that you put in. Like, let's say you put in 6% and your company matches 6. So you could take out the part you could never go into the part that the company put in.
Or you could take up to $50,000 maximum, half of what you've got in, not to exceed $50,000.
That's right. As long as it's vested.
Right.
So it's halfway. Well, they let that go a little bit. Loans all have to be paid back in 5 years. It's kind of a standard thing. 15 years if you're purchasing a primary residence. Like first time, remember if you're a first time buyer?
Sure.
If you're in a federal disaster area, you can get up to $100,000. Problem, remember, if you leave the company, they got to offset that loan. Some will let you roll it over into a new, some won't. So you got to be very careful, though. The reason you got to be careful, if you owe $50,000 and then you change companies that don't allow you to roll over that loan, now you got a $50,000 income added to your money for that year.
Unless you can
huge tax bill.
Unless you can immediately redeposit the money.
That's right. And 10% penalty from the IRS. So if you're under 59.5. So those kind of things aren't great. But just to give an example of who can take out 401k loans and and not medical expenses, this increases the amount. Primary residence, tuition, payments to prevent foreclosure of your primary residence,
Ouch.
Not a rental property.
Ouch.
You can't take out for a rental property. It had to be for primary residence. Burial expenses, of course, for close family. It had to be like your wife, kids, whatever. Certain repairs on a primary residence also.
How about a new boat? Something like that.
New boat, I don't think it would work. But be very careful. It is very enticing to take a 401k loan because it's easy to justify. I am going to take a loan out. I'm paying myself back, and I'm paying myself back interest.
I'm paying myself interest.
Why wouldn't that be a great deal?
I'm with you.
All right. The issue is this. If you do that, they prevent you from adding to the 401k for up to 6 months or whatever. And they'll lock it in where you can't add for a certain period of time. And that, compounded over 20 years or so, is a whole lot of money that you missed out on. It won't make up the interest you're paying yourself. It won't make it up, especially if you're maxing out a 401k or putting a large amount.
And if they don't hold you accountable, if they don't lock it where you can't add to it, which a lot of companies don't, you have to look at where your money's coming from that you're borrowing from yourself. If you're all in the market with your 401k, and most people are because that's the purpose of that, it's long term, you've got plenty of time, then you're not getting you're losing that rate of return. If it's a 20% year like last year, obviously you're getting hosed because you're only paying yourself 8% or something.
That employee goes, well, I got a $50,000 loan on $100,000, but they're not paying me interest on $100,000. I go, yeah. No, you have that money there. Well, it's a loan, so aren't I loaning against the stocks to keep the stocks there? I go, no, they're selling the stocks.
Yeah, you're liquidated. Yeah.
That would be nice, though.
Yeah.
Then I would change my position possibly. Wait a minute, I still on interest on 100, and I pay myself.
I think he's
interest.
confused with margining the account.
Yeah. Well, the days of margining have come way down, boy. Back in the 90s, everybody margined. Margin is you're basically borrowing money from a brokerage firm to buy more stocks.
And it was a way to tell if the market was doing well or not, or if it was getting ready to correct. And remember, just before 2000,
how much more?
Everyone is maxed out margin in the NASDAQ, the high-tech stocks.
Remember, always keep it in perspective. Market's gone up 9 years in a row. I looked at a retirement plan the other day, said, I like this retirement plan better than one you gave me, Victor. I said, all right, let me look at it. Well, it assumed average return on stocks of 10% a year.
Sweet.
So I'm like, okay, you're retiring in 10 years. He goes, that's right. Okay, so they've assumed you made 10 all the way. They're making another 10. Well, the market's gone up 9 years in a row. That would be 19 years in a row. Now, wait a minute. That's just till you retire. Then you're going to be retired for another 20 years. So what this plan has said, if you make 30 in the next 30 years makes 10% a year, and the previous 10 years makes 10% a year, you'll be fine. I go, that's like 50 years up in a row. He goes, no, the guy told me it's just averages. Averages don't matter. I go, the market's averaged 5% a year for the last 18 years. This century's 5% a year. So we got to ignore that part and say it's going to not only go up 9 years in a row, it's going to double that return for the next 40 years in a row.
And for all of you listening out there and saying 5% a year for the last 18 years, I don't know if I believe that. I know you wouldn't be calling us a liar, but the best nugget that we can share with you, and we've done it over and over and over so that you guys can really get it, is the reason it only averaged 5% is dividends are now 2.5 in the 60s and 70s, when you got that 12% average, or the number that everyone still uses to this day, 50, 60 years later. Dividends were 5%. So think about it. Dividends are half what they were.
S&P, I think they're 1.6, 1.8.
Yeah. So that's the difference. If you had that full 5-6% dividend, we might be at 10. Do you think we're going to get back there?
It's like the comeback of a person, usually a know-it-all person. They go, well, I only have AT&T dividend stock, and that's making 5 dividends. You're right, it's making 5 dividends, and you're risking all your money on one company.
That's right.
No, I got 4 of them. Okay, 4 companies, whatever. The risk of the S&P 500 with 500 companies has gone down 50% twice in the last 18 years.
That's right.
That's why the return's lower now. But remember, just to continue this trajectory of 5, you got to have some continued growth. I don't care what the political climate is or whatever. You're not having 19, 25, 30 years in a row going up. It's impossible. It will not happen. So don't base your retirement plan on that. I told you the Fidelity retirement plan bases it on that. On an average market return of 10, and they go under market, it's like 7. It doesn't work. You got to put reality in there and say, here's what we made. Okay, now, if you want to do a plan, you got to take a percentage of that. You don't go and say, all right, I'm going to plan for my retirement for it to make twice as much as it has the last 20 years. That's not a plan. That's a hope. That's a lottery ticket.
We talked about a show or two ago about, I don't know if you're using forward PE or Shiller's PE or what it was, but we talked about the average rate of return after such a large bull market. Mm-hmm. And I think the number was scary, like 2 or 3%, wasn't it?
2.1% is the best it's ever returned over the next 15 years.
So think about it. Now, we're not saying that's the deal, but if you have everything allocated correctly, your liquidity, your income bucket, and your stock market bucket, it won't affect you. You'll be prepared for it. Just our message is be prepared.
I'm going to tell you the worst thing that a financial advisor could ever tell you. And I bet you most of our audience has heard this answer. It's the worst thing. Let's say you're within 10 years to retirement, 5 years to retirement, or retired. We're going to keep doing the same thing. Stay the course. That is the absolute worst thing you could ever hear, because there's 2 parts of your financial life. There's the accumulation phase, and there's the distribution phase. You can be an expert in one and be horrible at the other. If you're one of those stock gurus that market made 5% the last 18 years, but you made 9%, you're a guru. You beat out 99.9% of our investors. I don't care. If you're not an expert in that distribution phase, you just mess up once in the retirement phase. Now I might be eating cat food when I'm 80. So you cannot stay the course. You cannot stay with the same mix of investments when you get close to retirement. Let me say, you can, but it is to your own detriment. Stock market was not made to take money out of the thing. And you cannot take money out of a possibly depleting asset. It's a place you can't go.
And if you get lucky all the way up until retirement and you don't lose half of your savings somewhere within the first couple of 3 years of your retirement, boy, please take all your money out at that point and lock it up safely, because you're extremely lucky.
Right. I mean, you have to do, like I said, that's why we do our bucket strategy. You've got to have an income bucket. Where are you going to get your income from? It can't be the mix of the whole thing. Oh, we're going to take a dividend from here, but you can't stay in the same kind of things. Now, don't get me wrong. If it's part of your stock bucket or growth bucket, you can have those same kind of stocks. Just the allocation percentages won't be the same. Because what somebody tells me that it's a managed program, oh, we've had it for 30 years, it's done great. I go, you bought that when you were 30 years old. It's 90% stocks. Do you think it's appropriate to be 90% stocks when you're 70? Well, sure, it's been doing its work for 30 years. That's a 30-year history. I go, It means nothing when you start taking distribution of your assets. You have to think about the taxation. You think about your legacy planning. You got to think of all these things. These are all disciplines that financial planners don't normally have. They're very good, I'll say most of them, very good at growing assets, very bad at distributing assets, because they'll ignore the sequence of returns risk. The sequence of returns risk is something that cannot be ignored. Talk to any academic. So it's different when you're getting an income stream off a portfolio. It changes everything. So unless your advisor is making drastic changes or starting to, when you get within that retirement red zone, within 10 years, already retired, anywhere in there, you need to really look at it because you're taking too much risk for the potential reward. You don't have an income stream that's a constant. It's not guaranteed long enough. You might have a 10-year plan, and you're like, well, my dad only lived to 70, so I'm fine. That doesn't matter. Like I said, my mother-in-law's in a nursing home. They'll keep you alive longer than you want to be alive. I'm telling you. You've got to have this stuff last. Yep. And let's say you're a couple and you both get 70. One of you gets dementia and goes to a nursing home. The other one still has all the bills.
That's right.
Now I got an extra $5,000, $6,000, $7,000 a month coming out. There's all those things you have to plan for. Let's say I want to leave a certain amount to my heirs. Is it best to leave these 401k accounts, the IRAs, or is it best to leave a non-IRA account? Should I spend down one or the other? That's questions that we are retirement specialists. This is what we do. Don't get me wrong, we manage money with younger people too, but we are very big experts on the distribution phase of your life.
And as often as we do this, and we do it all day, every week, every month, I mean, it's what we do. Every time we get a set of criteria or a different situation, like your situation may be, we have in the back of our head ideas, and we think we know where it's going to end up, but we don't do anything until we input it. We do several models. We take a look at it short, medium, and long term through your investment life, and then we can sit down and show you the options and let you pick what's best for your situation.
Yeah, some advisors are still more product oriented, and they're just basically calling you every once in a while with a product, which is fine. But if you start getting in that retirement red zone, you don't need a product, you need a solution. What you need is, okay, if you think this product is good for me, let's plug it into the portfolio and see what it does. Here's with it, here's without it. Here's without the strategy or current strategy versus proposed strategy.
Absolutely.
Those are the kind of things you do. Then you got to put inflation, you got to stress test the portfolio, all of those different things. But that'll give you an accurate assessment of what you have.
I do have a question though, Vic. When you're getting in that retirement red zone, are you coming out of the shotgun? I mean, using a football analogy, are you lining up in the shotgun to get into the red zone? How are you? I like the football analogy.
No, it's basically it's the cat food zone. I'm going to call it the cat food zone.
When you're in the red zone, are you going to run the ball? Is that what you're
right? People fear running out of money more than death.
Like public speaking is that way a lot.
Right. They fear it more than, so that's the first thing you need to address. I don't care. I have people that I'm telling you, they might have saved $1 million. They need $100 and something grand a year out of the portfolio, and they're confident that they're going to get it out of that portfolio. I go, oh, you can get it out of there. I just don't know how many years you can get it out of there.
The other fear they have, you may have $1 million, and I'll just give you some for instances because we work with the numbers a lot. You may be able to take half of that, $500,000, and guarantee a little bit more money income-wise than you need for the rest of your life in income with your Social Security and pensions that you have, and leaves the other $500,000 free, right? It's unencumbered now. It's not sequence of return risk where you're withdrawing off of a fluctuating asset, but it's still difficult to take. The same type of people that are scared to death of running out of money don't want to take $500,000 of their $1 million to secure it, not because it's securing it, but because they're spending $500,000 to do it. It's kind of counterintuitive.
Right. Yeah, it's hard for people when you allocate money to the income bucket that this is going to give you more money monthly, give you more money when you die, give you more flexibility.
More growth.
It's a hard concept that we have to deal with a lot, but it's allocation of money. Remember that allocation that won the Nobel Prize for economics. 90% of your variation in return is how they're allocated, not which stocks they have, not which investments they are. It's how they're allocated. That is magnified when you get in the retirement red zone. When you get if you're in retirement, it's worse. Getting ready for retirement, it's bad. You have to start converting that stuff if you can. If you're already there, you're there. But within 10 years of retirement, you can make great strides. You can really get towards that retirement thing and be prepared for retirement. We all have busy lives. Everything's busy. I don't have time for anything. I get it. But it's easy to procrastinate. Well, I'm not retiring for a few years. All of a sudden it's there. Then you go to the financial advisor, and you can do stuff with it, right? But it takes 3 times more money than it did if you'd have just came 5 or 10 years ago.
A couple years earlier.
People spend more time planning a vacation than their retirement. That's why it's so crucial with this because it's different than accumulation, just buying mutual funds, buying stocks. You have to have a financial advisor. You have to have somebody that specializes in that distribution phase when you get to the distribution phase or close, because it will help you tremendously. If you go to the same kind of person that just puts everything in a managed account and lets it go up or down, that's not going to help you in the distribution. You got to figure out, all right, what's the best way to get the lowest tax income? All right, I want the lowest taxes during I'm retired. Because some people have a deal and they just double their tax bracket when they're retired. That's not what I want to do. The paycheck stop. I should have a much lower retirement or tax level. And so that's just a few of the things we do. Remember, don't hesitate to call us. All of our retirement plans, stress tests, Social Security Optimizer, all of those are no obligation and no cost. Don't get me wrong. They take us hours to complete. And I promise you one thing. You will have a better assessment of what you have regardless. And it's 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. Go ahead, Guy. You're about to say.
No, I was just going to say the retirement analyzer is the most fun thing, and probably a little bit of redundancy, but it's great to be able to take a look in front in black and white and see at what age your money runs out with your current plan.
Well, our retirement plan software is the most comprehensive that I've ever seen. What you can do is you can take each individual expense that you have and put a different inflation number on it. Why is that important? Well, food does not go up with the price. Now, prepared food does. So, but I'm talking about food in general, like eggs. If they went up with inflation, that'd be $50, $75 for a carton. Now, they don't. So you can put a lower inflation on that. Now, what goes up more than inflation typically? Like medical costs. They've got a 7% inflation cost run on medical costs. That means over 20 years, it's 4 times what you're paying today.
Yeah, that's crazy.
And so, remember the old plans? I had no deductible, $5 blood. Now it's 10 times more for half the coverage. That's just the way it is. It's not going to go reverse. If you look at, everybody says Social Security is going to run out by 2035. Look at Medicare. It's already there.
Yeah, it's in trouble.
And getting worse every day. So what can they do? Raise the price.
Yeah.
That's all they're going to do.
But you know what? Everyone's milking the system, and I don't know how you can police it. I can give you an example with my mom. They want to give her free services, right? Medical services. Well, in order for her to get free services and for Medicare to take care of it, they got to send a nurse out once a week, a doctor every other week. She doesn't need all that. She's on no meds. She's in pretty good shape for her age, but they just inundate her with all of you have to do this or Medicare won't cover it. Oh. So they're all just stick it to Medicare.
Oh, it's a huge one.
And everyone piles on.
I'll get you free this, free that.
Free cards, free, electric cards, the whole thing.
So remember, the last thing is I want to tell everybody, target date funds. Everybody's putting their 401ks in target date funds.
Right.
I would suggest against that because target date funds are competing with each other. They're always too heavily geared in stocks.
Yep.
They're always, last time in 2010 when the market crashed, the average target date, or 2008, average target date lost 50%. Those people are supposed to retire in less than 2 years.
Yep.
The 2010 funds, and they just lost half the dang money. So they're not allocated correctly. It's an easy default. It's supposed to be.
Sounds good.
Yeah, when you're 30 years, if it's a real long way away, it's supposed to be almost all stocks.
Yep.
And then slowly creep up. It doesn't slowly creep up. It'll have a 70-year-old still at 75% stocks or equities, or have too much in international stocks because they're trying to compete in a global field of target date funds that are very popular. And so the only way to compete when bonds are paying crap is to have more stocks. So what you're doing is right now bonds are going down, right? Because interest rates are going up. Well, I need more stocks. Let's put more on the stock side. Otherwise, if I got 4 target date funds to choose from, a Fidelity 2020 fund or this fund's made 3% more a year.
They always choose the highest return.
That's right. It's the riskiest one.
That's right.
So unless they quit competing with each other, target date funds, you're way better off allocating it yourself. Well, that's our show, folks. I want to thank everybody for listening today. Don't hesitate to call our hotline if you have any financial questions or like to take advantage of any of our services. 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure for Guy Allert. We always, always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.